So please welcome me and join me in welcoming Bill Dudley.
Well, thank you very much, Ken, for those kind and gracious remarks, and thank you, Kathy Wild, for arranging this forum. It's a pleasure to have the opportunity to speak here today. I'm going to focus on the important lessons of the recent crisis and how those lessons should inform the regulatory reform effort. As always, what I have to say reflects my own views and not necessarily those of the Federal Open Market Committee or the Federal Reserve System. With that out of the way, in my opinion, this crisis demonstrated that a systemic risk oversight framework is needed to foster financial stability. The financial system is simply too complex for siloed regulators to see the entire field of play, prevent the movement of financial activities to areas where there are regulatory gaps, and when there are difficulties, to communicate and coordinate the responses in a timely and effective manner. Effective systemic oversight requires two elements. First, the financial system needs to be evaluated in its entirety, because as we have seen, developments in one area can often have devastating consequences elsewhere. In particular, three broad areas of the financial system need to be continuously evaluated: large systemically important financial institutions, payments and settlement systems, and the capital markets. The linkages between each must be understood and monitored on a real-time basis. Second, effective systemic risk oversight will require a broad range of expertise. This requires the right people with experience in operating in all the important areas of the financial system. In this regard, I believe the Federal Reserve has an essential role to play. The Federal Reserve has expertise and experience in all three areas. It now oversees most of the largest U.S. financial institutions. It operates a major payment system and oversees several others. It operates in the capital markets every day and managing its own portfolio, and as an agent conducting treasury auctions. And also as a central bank, it backstops the financial system in its lender of last resort role. Compared with where we were in late 2008 and early 2009, financial markets have stabilized, and the prospect of a collapse of the financial system and a second Great Depression now seem extremely remote. But even with this progress, credit remains tight, especially for small businesses and households. Economic regrowth has resumed, but employment has climbed to punishing levels. So while circumstances have clearly improved, they are still very far from what we want them to be. We have no cause for celebration when the challenges facing so many businesses and households remain so daunting. Aggressive and extraordinary official interventions were imperative to bring about this nascent stabilization of our financial markets and economic recovery. The Federal Reserve has been at the center of many of these interventions. For example, its efforts over the past 2 years to promote market functioning and to minimize contagion were critical in preventing the strains in our financial markets from resulting in even more severe damage to our economy. These lender of last resort interventions on the part of the Fed, including facilities such as the Term Securities Lending Facility, or TSLF, and the Primary Dealer Credit Facility, or the PDCF, as well as programs as the foreign exchange swap agreements, are examples of the rapid and responsive application of basic central banking tenets to the unique challenges we faced as the crisis evolved. Indeed, in many ways, the crisis has underscored why the Federal Reserve was created almost a century ago, to provide a backstop for a banking system prone to runs and financial panics. Where it proved necessary and feasible to do so, the Fed also used its emergency lending authority to forestall the disorderly failure of systemically important institutions. These actions were extraordinary, well outside the scope of our normal operations, but our judgment was that not taking these actions would have risked a broader collapse of the financial system and a significantly deeper and more protracted recession. Faced with the choice between these otherwise unpalatable actions and a broader systemic collapse, the Fed, with the full support of the Treasury, invoked its emergency lending authority and prevented the collapse of certain institutions previously considered to have been outside the safety net. The fact that the Fed needed to take those actions provides a stark illustration of the significant gaps in our regulatory structure, gaps that must be eliminated. Among these holes was the absence of effective consolidated oversight of certain large and deeply interconnected firms, the collective failure of regulators, including the Federal Reserve, to appreciate the linkages and amplification mechanisms embedded in our financial system, and the absence of a resolution process that would allow even the largest and most complex of financial institutions to fail without imperiling the flow of credit to the economy more broadly. Addressing these shortcomings will require important reforms in our country's regulatory architecture. We entered the crisis with an obsolete regulatory system. For one, our regulatory system was not structured for a world in which increasingly large amounts of credit intermediation were occurring in non-bank financial institutions. As a result, little attention was paid to the systemic implications of the actions of a large number of increasingly important financial institutions, including securities firms, insurance conglomerates, and monoline guarantors. In addition, many large financial organizations were funding themselves through market-based mechanisms such as tri-party repo. This made the system as a whole much more fragile and vulnerable to runs when confidence faltered. With the benefit of hindsight, it's clear that the Fed and other regulators here and abroad did not sufficiently understand the importance of some of these changes in our financial system. We did not see some of the critical vulnerabilities these changes had created, including the large number of self-amplifying mechanisms that were embedded in the system. Nor were all the ramifications of the growth in the intermediation of credit by the non-bank or shadow banking system fully appreciated, nor their linkages back to regulated financial institutions. Those were not understood until after the crisis began. With hindsight, the regulatory community undoubtedly should have raised the alarm sooner and done more to address the vulnerabilities facing our banks and our entire financial system. But this was difficult because our country didn't have truly systemic risk oversight that would have been better suited to the new world in which markets and non-bank financial institutions had become much more important in how credit was intermediated. Without a truly systemic risk perspective, it was unlikely that any regulator would have been able to understand how the risks were building up in our contemporary market-based system. The problem was that both banking and non-banking organizations played an important role in credit intermediation, but were subject to differing degrees of regulation and supervision by different regulatory authorities. Although these gaps had existed for years, their consequences were not apparent until the crisis began. Difficulties in one part of the system quickly exposed hidden vulnerabilities in other parts of the system in a way that our patchwork regulatory system had not been designed to detect or readily address. In the same way, the crisis revealed the critical deficiencies in the toolkits available to the regulators to deal with non-bank institutions in duress. Emergency lending by the Fed might be enough to forestall the disorderly failure of a systemically important institution and all the wider damage such a failure might cause, but it was a blunt and messy solution employed as a stopgap measure because better alternatives were not available. What is needed, what our country still lacks, is a large firm resolution process that would allow for the orderly failure even of a systemically important institution. Thus, in the fall of 2008, regulators and policymakers found themselves facing the prospect of a total collapse of a complex and interconnected system. It was these circumstances and the prospects they created for an even deeper and more protracted downturn in real economic activity and employment that required extraordinary actions on the part of the Federal Reserve, the Treasury, and many other agencies. This is a situation in which the United States must never find itself again. For its part, the Federal Reserve is hard at work on developing and implementing new regulations and policy guidance to take on board the lessons of the recent crisis. We are working with other banking regulators in the United States and overseas to strengthen bank capital standards, both by raising the required level of capital where appropriate and improving the risk capture of the current standards. We're issuing guidelines and compensation practices so that financial sector employees are rewarded for long-term performance and are discouraged from excessive risk-taking. And we are working with foreign regulators to develop more robust international standards for bank liquidity. We are working to make the tri-party repo system more robust and working to reduce settlement risk by facilitating the settlement of over-the-counter derivatives trades on central counterparties, or CCPs. But more needs to be done, and much of this requires action by Congress. Congress is now considering several proposals for comprehensive regulatory reform, proposals that merit careful study and debate. Let me offer some general thoughts on principles that should guide how we approach reform. First, it's important to take a clear-eyed and comprehensive view of the financial system that we have in place today. As I've already suggested, if there's one overriding lesson to be drawn from the events of the past 18 months, is that the financial system is just that, a system, and a very complex one at that. The operational, liquidity, and credit interdependencies that characterize contemporary financial markets and institutions mean that the well-being of any one segment of the system is linked to the well-being of the system as a whole. Because of this, our approach to reform must be guided by a coherent sense of the system as a whole, not merely by a focus on some of the component parts, as important as they may be. We need a regulatory structure that provides for comprehensive and consistent oversight of all elements of the financial system. This includes effective consolidated oversight of all our largest interconnected financial institutions, oversight of payments and settlement systems. We must make sure that the people doing the regulation have the power and expertise to ferret out and bring to heel regulatory evasion as it occurs to prevent abuse and excess from building up in the financial system. In the end, the gaps, not the overlaps, have been the main shortcomings of our existing regulatory framework. A second fundamental point is regulatory reform has to ensure that the financial system will be robust and resilient even when it comes under stress, so that it will not fail in its critical role of supporting economic activity. No economy can prosper without a well-functioning financial system, one that efficiently channels savings to the businesses that make the most productive use of those savings and to consumers that need credit to buy a home and support a family. The fact that our financial system isn't functioning particularly well right now is part and parcel of our current economic difficulties. The critical link between the real and the financial is why we care so much about the systemic risks inherent in banking and finance. One critical element of systemic risk is what is known as the too-big-to-fail problem. Without sufficiently high capital and liquidity standards, and as a backstop, a resolution mechanism that is credible, regulators are faced with a Hobson's choice when a large, systemically important financial firm encounters difficulties. On one hand, if it authorizes the authorities to step in to respond to prevent failure, contagion, and collapse of the broader system, that action rewards the imprudent and can create moral hazard. That is, it can encourage others to act irresponsibly or recklessly in the future in the belief that they too will be rescued or bailed out. On the other hand, if the authorities do nothing and let market discipline run its course, they run the risk that the problems will spread and unleash a chain reaction of collapse with severe and lasting damage to markets, to households, and to businesses. So what can we do about the too-big-to-fail problem? It is clear that we must develop a truly robust resolution mechanism that allows for the orderly wind down of a failing institution and that limits the contagion of that failure to the broader financial system. This will require not only legislative action domestically, but intensive work internationally to address a range of legal issues involved in winding down a major global firm. Second, we need to ensure that the payments and settlement systems are robust and resilient. By strengthening financial market infrastructures, we can reduce the risk that shocks in one part of the system will spread elsewhere. Third, we need to reduce the likelihood that systemically important institutions come close to failure in the first place. This can be done by mandating more robust capital requirements and greater liquidity buffers, as well as aligning compensation with the risks that are taken by the firm's employees. In addition, instruments such as contingent capital, that is debt that would convert automatically into equity in adverse environments, needs to be considered. Such instruments would enable equity capital to be replenished automatically during stress environment. This would serve to dampen shocks rather than exacerbate them. I'd now like to take some time to discuss some of the proposals that Congress is debating regarding regulatory reform. As Congress and the administration consider what legislative changes are warranted, the Federal Reserve's actions before and during the crisis have been getting close inspection. Given the Federal Reserve's key role in our financial system and the scale of the damage caused by the financial crisis, this careful scrutiny is necessary, appropriate, and indeed welcome. Not surprising, there are legislative proposals that would significantly alter the Federal Reserve's powers and responsibilities, particularly with respect to supervision of bank holding companies. Again, that's entirely within Congress's purview. The Federal Reserve only has the power and the responsibilities that Congress has entrusted to us. But in drawing up new legislation, it's important not to throw the baby out with the bathwater. We should preserve what has worked and fix what hasn't. A dispassionate analysis of what is needed will almost certainly lead to better decisions and a more effective regulatory framework. The legislative proposals concerning the Federal Reserve are not limited to the Federal Reserve's role in supervision. Consider, for example, one proposal that calls for what it terms, quote, audits, unquote, of the Federal Reserve by the U.S. Government Accountability Office, or GAO, an arm of Congress. These would not be audits at all in the commonly understood sense of the term. The Federal Reserve's financial books and transactions are already audited by a wide range of professionals, internal and external, to the Federal Reserve. Rather, these new audits would involve an ex post review of Federal Reserve monetary policy decisions, a potential first step towards politicization of a process that Congress has carefully sought to insulate from political pressures. The notion that the Federal Reserve's financial dealings are somehow kept secret from the public is a surprisingly widely held view, and it's simply incorrect. An independent outside audit of the Federal Reserve's books is conducted annually. You can find the results online, including a detailed accounting of the Federal Reserve's income and operating expenses in its annual report. The financial books of the regional Federal Reserve banks, including the New York Fed, also undergo independent outside audits, also available online. In addition, the GAO is empowered to review almost all Federal Reserve activities other than the conduct of monetary policy, including the Federal Reserve's financial market operations, which the GAO has done so frequently. The Federal Reserve's balance sheet is posted online weekly with considerable detail in what's called the H41 report. And finally, an additional accounting of the Federal Reserve's emergency lending programs created over the last 2 years. It's also available online in a monthly report. But my objection that GAO oversight would be broadened to include a review of monetary policy decisions is not just based on the fact that we're already subject to considerable oversight. My principal concern is the damage that could potentially result to the Fed's ability in achieving its mandate of price stability and maximum sustainable employment. The effectiveness of monetary policy depends most of all on the Fed's credibility with market participants and investors. In particular, both groups need to know that the Federal Reserve will always act to keep inflation in check. That's why Fed Chairman William McChesney Martin famously joked that the Fed would sometimes need, quote, to take the punch bowl away just as the party gets going, unquote. As you can imagine, this may not always enhance our popularity, especially among those who are enjoying the party. But the fact that markets know that the Federal Reserve will tighten monetary policy when needed helps keep inflation expectations in check. This in turn helps keep inflation low since inflation expectations affect actual inflation. The consequence is credibility with respect to the conduct of monetary policy. This gives the Fed more latitude not to tighten when inflation rises for transient reasons, say due to a short-lived spike in oil prices, and more scope to ease credit to support the economy during economic downturns. Recognizing these benefits, Congress wisely acted many years ago to exempt monetary policy decisions from the GAO's wide powers to review Federal Reserve activities. Congress's decision to bolster the Fed's monetary policy independence has been followed by similar actions around the world. Substantial independence for the central banks in the conduct of monetary policy is now widely regarded as international best practice. Policy independence does not absolve the Federal Reserve from accountability for its monetary policy decisions and the need to explain clearly why they were taken. But it avoids the politicization of monetary policy decision-making. And this is good because politicized central banks generally do not have enviable records with regard to inflation, economic growth, or currency stability. Risk premium on financial assets are typically much higher in countries with politicized central banks. Of course, a reversal of Congress's early decision would not amount to legislative control over monetary policy decisions. That's not the issue. The issue is that a reversal of Congress's early decisions could create the appearance that the legislature seeks to influence monetary policy decisions by establishing a mechanism to publicly second-guess those decisions. Such a move would blur what has been a careful separation of monetary policy from politics. Market confidence here and abroad in the Federal Reserve would be undermined. Asset prices could quickly build in an added risk premium, which might lead to tighter credit conditions. These unintended consequences would undermine the legislation's intent. I'm also concerned about those proposals under consideration that would move the regulatory and supervisory functions now held by the Federal Reserve to other agencies, new or existing. At present, the Federal Reserve is the consolidated supervisor for bank holding companies, a group that has expanded recently as investment banks and other companies formerly outside the Federal Reserve's purview have been brought under the Federal Reserve's oversight. In my view, further disaggregation or fragmentation of regulatory oversight responsibility is not the appropriate response to our increasingly interconnected and interdependent financial system. Funneling information streams into diverse institutional silos leads to communication breakdowns and too often to failure to connect the dots. In addition, there are clear synergies between the supervisory process and the Federal Reserve's monetary policy and financial stability missions. The information we collect as part of the supervisory process gives us a frontline, real-time view of the state of the financial industry and broader economy. Monetary policy is more informed as a result. Only with this knowledge can the central bank understand how the monetary policy impulse will be propagated through the financial system and how this impulse will affect the real economy. Similarly, involvement in the supervisory process gives us critical information in fulfilling our lender of last resort responsibilities. Information sharing with other agencies is simply not as good as intimate knowledge and understanding of markets and institutions that is gathered from first-hand supervision. Indeed, many institutions at the center of the crisis, and arguably the most troubled, Bear Stearns, Lehman Brothers, Merrill Lynch, AIG, and the GSEs, were not supervised by the Federal Reserve. Consequently, when those institutions came under stress, the Federal Reserve had poor quality and far less timely information about the condition of these institutions than would have been the case if we had had the benefit of direct supervisory oversight. In fact, some of the hardest choices the Federal Reserve had to make during the most chaotic weeks of the crisis concerned systemically important firms that we did not regulate. It is not surprising that in the wake of the crisis, some countries that had separated bank supervision from the central bank monetary policy role are now reconsidering that division of labor. That is mainly because coordination problems created difficulties in responding quickly and effectively in the crisis. Separation made it more difficult to communicate in a timely way and to understand the broader implications of what was transpiring. It's critical that we do not introduce new inefficiencies, impediments into our regulatory system. No matter what steps are taken to improve the system and strengthen market discipline, history tells us that there will inevitably be circumstances in which an informed and effective lender of last resort will play a critical role in preventing shocks and strains in financial markets and institutions from generating into a broader collapse of the financial system. Of course, there are legitimate questions as to how broad the Federal Reserve's regulatory and supervisory responsibility should be. That question is up to Congress and should be decided on the merits. What fundamentally at issue here is not turf, but rather how we as a nation can best ensure that we never relive the events of the past few years, that the legitimate public interests associated with a safe, efficient, and impartial banking and financial system are well served. In the end, it's critical that the financial reform be decided on the basis of the merits. If objective and careful policymaking prevails, we'll all be better off for it. In contrast, if we fail in this endeavor, that would be truly tragic. We must act informed by the important lessons that we have learned from this crisis. Thank you for your kind attention.
If I could ask the panelists, and Bill, we're all going to, just sit down here. But thank you for those remarks and the overview and the willingness to take some personal positions on some of the tough issues that we're confronting in financial reform. Let me start off with Dennis Hughes. And Dennis, you're in a unique position. as a labor leader and chairman of the New York Fed. And it would be helpful to elaborate some on Bill's remarks, but particularly from the standpoint of why the Fed is under particular pressure now, and what does the public need to know about its importance?
Thank you. Thank you for the. Let me open up by saying it's kind of I'm in an interesting role. It's almost a schizophrenic role in a way, because I have to be two. In one day, I could be two people at the same time. You know, it's kind of a crazy thing. But to answer your question, I would say that the real challenge for the Federal Reserve System now, as I see it, is that there is a certain confidence that the financial industry has in the Federal Reserve System, but that confidence is not shared by the general public. The general public has really no understanding of what the system does, how the system works, the limitations of the system, and how, in fact, that system has prevented a real catastrophe from occurring over these last 2 years. Now, saying that, as Bill laid out before, there is this whole issue of transparency. Transparency in the Federal Reserve System is sometimes required, but having sensitive information hit the airwaves, the press, usually in financial situations causes nothing but chaos. So where are we at this point with the Federal Reserve System? The first challenges, I think the most important challenges that we have, is to make sure that people understand the role of the system. That the system exists primarily to stabilize the banking system. What we saw recently over the last 2 years was really an anomaly. The Federal Reserve System doesn't get into that type of direct, I guess, I wouldn't say, I said direct activity with the business, private industry in this country. But yet somehow the average American thinks that that happens all the time. The second piece is that the average American and my members generally feel that the Federal Reserve System is a system that does not work for them. It's a system that is built for the benefit of the banking industry in this country. In a sense, that's correct. It is a stabilizing system, a system that does the day-to-day things, make sure the payments are made, checks are cleared, things of that nature. Now, let me just finish by saying this, that there is a real danger that Congress, public opinion, and media interpretation will change the Federal Reserve System in a way that will make it inefficient. Not only inefficient, but maybe irrelevant. It is up to all of us in our conversations with our colleagues and with the press, whenever the issue comes up, to point out that the Federal Reserve System is a necessary system. It is a system that operates differently based on crisis, different crisis. It is a flexible system. It is an independent system. And it is a system that, although can always be adjusted to meet the current times, is a system that has worked very well for the last 80 years and has really had a tremendous impact on the stabilization of our economy for most of those 80 years. So I guess the real question, maybe we can get to it here today, is how, in fact, are we going to work as a community, as a financial community, labor community, political community, to make sure that this system still works, still is able to do its job, and still is able to generate the confidence not only of the participants in the banking system, but of the general public.
Thank you, Dennis. Roger, you know 2 or 3 things about how to manage through a crisis, given the terrific leadership job you did post 9/11 to stabilize the financial system. Do you have any advice and questions for Bill from your perspective as a former Fed governor.
Right. I will say when I was a Fed governor, the one thing I didn't want was advice from former Fed governors in front of a room of New York business leaders. Let me do a couple of things. One is differentiate what I had to deal with after 9/11 versus what Bill and his colleagues are dealing with today. And I think Bill put his finger on it. The 9/11 crisis, and there are people in the room who are living with it, living through it with me, was primarily a crisis around operational infrastructure in this part of New York, sadly, as we all recall. As Bill points out, it was a place where the Fed had deep expertise. I happened to be involved with the payment system committee. We had good information. We had direct contacts, et cetera. It's a very different crisis, no less important, no less stressful, but quite different from a broad systemic crisis. And so I give the Fed high marks for having a deal in an area that is fuzzy and uncertain, and as Bill said, in which, frankly, systemic oversight, systemic regulation, systemic understanding was until recently quite rudimentary. And I would argue even now it's only getting to a place where it's starting to broadly understand the complexities. My question back to Bill is to pick up on one of your important themes, the disconnect between financial markets and the real economy. And one thing that I've observed is for many people in this room, financial markets actually are healing, right? Equity markets look good. Those of us who run large companies, as you probably know, and David Heleniak knows for sure, are out borrowing money at very favorable terms. For the first time in some time, liquidity is returned for corporations. So in some cases, the real economy financial markets are working pretty well. What do you say, Bill, to many of Dennis's members, many of my participants, who pick up on your first sentence, which is, gee, New York seems to be working well, fixed income markets are working well, equity markets are rallying perhaps, yet I cannot get access to credit to do small things in a small town. How do you respond to that concern?
I think that's accurate, Roger, that the capital markets have improved in health more rapidly than the banking system has improved in health. And part of that reflects the fact that in the capital markets, things are mark to market, so all the pain is sort of felt sort of instantaneously as the bad events occur. While in the banking system, where assets are marked on a more accrual basis, the losses sort of creep out over a longer period of time. So the households and smaller businesses still don't have the access to credit that the big companies have, and that's because the banking system is still under quite a bit of strain. Credit card losses, small business loan losses, commercial real estate losses, the banking system is still working through that. The second reason why it's taking longer for the banking system to heal, frankly, is the fact that the banking system has more to do in some fundamental sense, because the shadow banking system is much, much smaller today. And so activity that would have taken place before outside of the banking system now has to go through the banking system. And the banking system doesn't really have the ability to, very, very rapidly, to adjust its capacity to be able to handle that activity. I think things are improving. I think the banking system is fundamentally in much better shape than it was a year ago. I think the ability of some of the large banks to go out and raise large amounts of equity capital have really shored up confidence. But it is a healing process, and I think it's going to take some time. It's one reason why we have our monetary policy setting where it is right now, to try to accelerate that healing process.
Bill, just one comment that I would make before passing it on to Raj, that I think we need to be focused on relative to lending with small business and consumers is the deleveraging that's going on and the increase in savings rates. The reality is, if you look at the historical level, the highest rate of utilization in a number of consumer credit card portfolios and small business portfolios, it's 25%. I think the American public probably believes it was 50% or 60%. And if you talk to many institutions, the difference is around 1 to 2%. 1 to 2%. So the reality is, in my view, it is not just an issue of extending lines of credit. It's what are the incentives that consumers and small businesses have to activate the lines of credit. There are certainly a number of very low creditworthy people who want more credit. And I want to be very clear, I think lending needs to be increased to small business and consumers. But I also think we need to understand the deleveraging that's going on in the system and the savings rate, which very frankly I think is a good thing for society over the moderate term. But I think we need to also understand what tax incentives can play a role, what are some of the other measures that in fact can incent people to activate the lines, because you just go back through history in 2007, 2005, and the utilization rate was approximately 25%. That's an important reality that I think we're going to have to deal with in incorporating a multifaceted approach to how we can spur lending and how we can spur growth in small business and consumer.
I think you're certainly right, Ken, that the amount of credit outstanding is a function both of supply and demand.
Right.
And to the extent that people feel that they're over leveraged and are therefore pulling back in terms of their demand for credit, there's not much that the banking industry can do about it. But I think there are areas where clearly the credit availability is not as good as what we would like because of the strains on the banking system. So it's a little bit.
No, I think
it's a little bit of both.
Targeted plan. Let me just turn to Raj from Cohen from a regulatory perspective. Raj, Bill talked a little bit about his perspective on the reforms in Congress. Where do you think some of these reforms are going to end up? Particularly those reforms that are intended to prevent another crisis. And how does the Fed, from your perspective, fit into all of this?
Well, thank you, first of all, Ken, very much for hosting today. And I think you'll hear quite a fair amount of agreement between Bill and me. When you consider that just 15 months ago, we were on the verge of a true financial collapse, at least as a policy matter, I would suggest that it is unthinkable that we could not have truly comprehensive regulatory reform legislation. Now, for that legislation to be effective, it must answer two basic questions. First, what will the structure be? And second, who implements that structure? Structure. I think there need to be about 6 key elements. And I think these will all be there ultimately. One, as Bill indicated, there must be systemic regulation and oversight. Second, there must be regulation of all institutions and all products that can have a significant impact on the financial markets. Third, there must be better protection of consumers. Fourth, there must be more effective regulation of risk at individual institutions. True, that must encompass more robust uniform standards, but it also must encompass more focused supervision on the individual institution. Fifth, there must be repudiation of too big to fail, but that must not occur at the cost of incorporating a concept of big is bad. And sixth, all of this must be tempered by recognition that risk must be managed and controlled, but it cannot be eliminated. Now, even if we get the structure right, it must be administered by a regulatory agency with the expertise, the talent, and the independence to be truly effective in implementing that structure. And in my view, we just described the Federal Reserve. I truly hope that the leaders in Congress have paid careful attention to Chairman Paul Volcker's speech last Thursday at the New York Economic Club. I mean, after all, there is no one with greater intellectual integrity or more knowledge of our system. And as he explained, a divorce of monetary policy from regulatory oversight weakens both. Now, as Bill acknowledged, the Fed did make some mistakes both before and during the financial crisis, but they got so much more right. And why would you want to substitute a new agency that has no experience, no esprit de corps, and whose independence would be threatened from the outset by its political heritage? Just one last comment. Bill referred to connecting the dots and the importance of that. And that bears a striking resonance to what happened in the attempted Christmas Day bombing. There was a failure in the intelligence community to connect the dots. There would likewise be a failure if we could not connect the dots in financial regulation.
Thank you very much, Rob. Let me turn to Rob Hinrichsen. And Rob, there are probably still some open questions in your mind as you think about these issues and the role of the Fed and the crisis. But are there some issues that Bill or the panel have not addressed that you think need to be mentioned?
Well, first, I think I was going to comment on the schizophrenic comment. I'm as schizophrenic in some ways as anybody on this panel, certainly, and I'll get to that in a second. I would say that I have a question, and the answer has already been embedded in Bill's statements. But I have to put this in a context for you. First place, it was Ken mentioned that I'm chair of the Financial Services Forum. I would correct that and say I was chair of the Financial Services Forum over the last 2 years, but that chairmanship ended on December 31. Now, you might say, why even mention that? Because of the activities occurring over the last couple of years, that chairmanship, and indeed being on that with that group of people, 18 CEOs, primarily banking organizations, gave me some insight into the way banking organizations think, but probably more important, the language that they use. Keep in mind, this is the schizophrenic part, that the business of insurance in the United States is regulated by the states. So therefore, if you said, well, Rob, did you have a Washington office? And if so, why? If you weren't regulated by the federal government or by agencies of the federal government, I would say, well, our products and services and our balance sheet and whatnot regulated by the states, but activities that we do that our customers use our products and services for then get into areas of their regulation like PBGC, the Department of Labor, the IRS, and so forth. And so if someone said, were you familiar with Washington from a business point of view prior to the last couple of years, I would say yes, but I'd have to qualify it in that context. And so you can imagine when the meltdown occurred, or the financial crisis, if you think about it, virtually all of the language and the descriptions of not only what happened, but what the solutions could or might be, and the federal agencies involved, was all couched in what I'd call bank language. And for that reason, that's the schizophrenia, taking the bank language and making sure that there's no unintended consequences that would be totally inappropriate in the insurance world. So if you think about it, and my question is really about the future, Bill. It's not about the present, but I would say just to give an example of what's being discussed now, in a naive way, one might say, well, if you look at the federal government, what's the issue that the insurance industry had, and I'll speak for the industry as opposed to a particular company. It was when stuff started to happen, we literally had no one to email, nobody to BlackBerry, no one to call in Washington, because there is no, one would argue, I don't mean with individuals, but there's no agency in Washington that understands the insurance. Plenty of smart people, but that's not their focus. Now, as we speak, there's a lot of discussion going on about things that I think all start, in my mind, from the definition and understanding of systemic risk, which include questions like resolution authority. Okay, think about resolution authority if you're an insurance executive. It's totally different than, let me put it this way, resolving a failed insurance company is a totally different exercise than resolving a failed bank. And so when you look at the language and the folks that are discussing all of this, you have FDIC, the Fed, the New York Fed, and others, who now, because of the last 2 years, I happen to know all these people. You got to understand, prior to the last couple of years, I really had no reason from a business point of view to be visiting people in the Fed or the Treasury or whatnot. So it's been a tumultuous time in the sense that the big question is, how can we help to make sure that when everything is resolved, because there will be, and as Bill said, it's not about turf, but the resulting structure and responsibilities will be the result of turf discussions. And so the question is, after everything is settled as to who's responsible for what, how do we make sure that the communications, the understanding, the language doesn't fall back into what I would call turf battles? Because if you're running a business, it's not so much I want a level playing field or I want this, that, and the other, but you have to have some certainty. And even if you're principles-based, which I think is very difficult to say there's anything wrong with principles-based thinking, but the fact is, once, it's sort of like in Europe, there was, once upon a time, everything was principles-based. We come to create this country, and from a historic point of view, it's kind of like, well, principles-based is okay, as long as the king is okay. And so the analogy would be, principles-based is a good thing, but somehow you have to have rules of the road so you can manage your business going forward. And to the extent the insurance business is different, this almost requires open communication between various regulators, including the states. So, is that a question, Bill?
I mean, I think that we're not going to end up with an Uber regulator, clearly, and I think the insurance industry is very different. But what happened in the insurance industry, in a particular case of one company, AIG, was a great example of regulatory gaps in the system, in the sense that the Office of Thrift Supervision, which was their consolidated supervisor, was probably not the right regulatory authority to have oversight over AIG financial products and all the complex business that they were overseeing. So I think that insurance will be treated differently than the rest of the financial sector. But I think the important thing is to make sure we don't have the kind of gaps that we had with AIG, which was really happening at the holding company level, not at the insurance subsidiary level. The insurance subsidiaries of AIG were fine. It was really what was happening at the holding company level that created the problem.
The challenge, of course, and then just a thought on that, is that if you're speaking to anyone who is smart and open-minded but unfamiliar, when you start off by one way or another saying, yes, but we're different, of course the response is, well, everybody says they're different. So wait to see what happens and then deal with it. And of course that's the interesting time we have.
I think insurance companies are also different just in terms of the structure of their assets and liabilities, and sort of the one of the things that we saw during the financial crisis was the risk of runs. And I would argue that for a lot of insurance products, you're long on assets. You don't have a risk of your liabilities running off very quickly. So I think it does put a good chunk of the insurance industry sort of in a different place than, say, the banking industry or the securities industry.
What we're going to do is open the floor. We've got a few minutes left for questions, and I guess accordance with Fed protocol, we won't be entertaining questions from the press. But what I thought we might do is start off with Richard Neiman, Superintendent of Banking for the state of New York, and also on the TARP Oversight Committee. And it'd be useful to have some comments from you, and then we'll really open up the floor to questions that anyone has.
Thank you very much. And it's not easy to add to that level of insight that's already been contributed. But if I had to add a thought, I would really emphasize to the degree to which all of us stand to lose if the growing populist anger and opposition to the Fed's role are successful. From my perspective, there are really three areas of greatest concern, and I think Bill really touched on them to a great degree. One, the Fed's responsibility with respect to systemic risk. Two, their ongoing supervision, and it's particular of importance to us at the state level because the Fed is our federal partner with respect to large member banks chartered in New York, including Bank of New York Mellon and Goldman Sachs Bank, our newest bank, as well as almost all of the foreign banks operating in the U.S. through branches. And then a third would be rulemaking. And there the example I would give is the Fed's thoughtful and independent approach it's been taking to executive compensation and the appropriate alignment of risk and compensation. And my fear is that this populist anger and in Washington backlash can really could drown out this thoughtful and independent approach that the Fed is taking to executive comp. So I am interested in Bill's thoughts on what are the greatest dangers to us all, and what can we do to assure that we retain that level of independence and insight into our supervisory system. Thank you.
Well, I think that, my view is that, one, we have to articulate a little bit better why the Fed did what it did, that the Fed didn't do this because they wanted to do it, but because the interventions were necessary to prevent a broader collapse of the financial system, and then its consequences for the real economy. People act like financial systems over here and Main Street's over here, but they actually are very closely connected. And if the financial system had collapsed, which I think there was a very high risk of that happening in the fall of 2008, we wouldn't have just had a deep recession from which we're now emerging. We would have probably had something much more catastrophic than that. So that's the first piece. The second piece, I think, is we need to, on the compensation piece, is we need to be smart. I mean, the key issue here, I understand why people are upset. I think it's completely reasonable why people are upset about bank compensation. The Federal Reserve basically intervened and protected the financial system, and by protecting the financial system, it protected banks. And by protecting banks, some bankers survived, and now they're going to get paid a lot. And that's very unfair in the context of a 10% unemployment rate with a lot of households and businesses in the United States, smaller businesses, really suffering. So I completely understand that. The problem is we didn't have the tools to be able to differentiate. We didn't have the ability to, our choice was save the financial system or not. And we made the choice that saving the financial system was the right choice. It would have been nice if we could have made more finely tuned choices, because it is unjust what has happened. Our approach on compensation is really consistent with our mandate for safety and soundness, financial stability. So we are implementing a set of compensation guidelines that focus on risk-taking of financial institutions to make sure their compensation practices are closely tied and to be consistent with their financial soundness and financial stability. So that means that people get paid on the basis of multi-years. They get paid so that you don't have a situation where the trader can make lots of money in year one, get paid, and then lose lots of money in year two and still take home their pay from year one. So clawbacks, deferral of compensation. I think you're going to see that when Wall Street announced all their compensation plans in the current year, that there's actually been a lot of movement in the right direction. The Financial Stability Board is in the process of making sure this happens globally. The United States has endorsed the Financial Stability Board principles on this. It's very important that this be done globally across the world, because otherwise people will, the activity will move to where the rules are less strict. So I think that we're making a lot of progress, but more needs to be done.
Yes, Alan Fishman. If people could just state their name and who they're with.
Hi, I'm Alan Fishman. The intersection of what Dennis was commenting about, which is his members or Main Street, and what Raj said, the consumer protection, and when that becomes in conflict with product devices. So when you look at things like no prepayment penalties on residential mortgages, which drives tremendous complexity into the product and the management of the product and the risk around it. How do you and this is where the political challenge is going to be for the solutions here. How do you begin to reconcile just fundamental changes in product and consumer activities from the regulatory challenge?
Well, I think there's no question that consumer protection does have implications for safety and soundness. And I think we saw that in a couple areas in the last few years in terms of, one, the underwriting practices especially for subprime and Alt-A mortgages. I would argue that the problem in the mortgage market is not the design of the mortgage instrument. It's the problem in the mortgage market came about from underwriting practices that were way off the reservation. And those underwriting practices fueled demand for housing that then drove up housing prices and then set the stage for the collapse in the housing sector. So I think, so that's where a classic example where consumer protection then starts to impact financial stability. And so, of course, we need to be concerned about that. But I would argue that the design of the mortgage instrument, the fact that there's no prepayment penalty, I think that was a way down the list in terms of things that I would say that were responsible for the financial crisis.
Bob?
Chairman Volcker has called for the removal of hedge fund activities from the commercial banking environment. Do you have any thoughts or comments on?
Well, I think that I understand where Paul Volcker is coming from on that. The idea that if we're providing essential support to support financial stability, why should we be supporting the essentially gambling activities of some of these financial institutions? So I have a lot of sympathy with that line of attack. I think the problem is that it's going to be a little hard to separate what's truly a agent function from what's a principal function. A securities firm that's running a trading book is acting as an agent, but it also has risk on its books, and so the line of dividing exactly what's agent activity from what's principal activity is a little bit blurred. It's a little bit grayer than maybe what those comments suggest. But I think that things that are clearly principal risk-taking, you could argue that as long as they're not systemically important, and then you have to put in that qualification too, then maybe that could take place outside the safety net. I think the reality is, though, we have to be careful about sort of exempting certain forms of activity as being outside the safety net, because if we're increasing the capital requirements and liquidity standards on the things that we regulate, that will just incent business outside, and that could, it might not be systemically important today, but it could be systemically important in the future. I mean, long-term capital management, if you remember back in the late 1990s, created what I think was a systemically important event, even though it was a hedge fund. So I'd be careful to say that hedge funds should be sort of excluded from oversight, because I think that could be an area of systemic. I mean, hedge funds didn't cause a lot of set of problems in this particular crisis, but there's no reason why they might not cause problems in the future.
To follow up on, I think, Raj's key comment about connecting the dots, and Bill, your background as an economist, it seems as though we react to bubbles, and in fact, monetary policy and broader federal policy has been very aggressive in reacting to bubbles. What sort of input do you have on the ability to predict those bubbles in advance, or at least monitor them to some degree so that we're better able to manage it?
Well, there's a huge debate on financial asset bubbles, whether you can anticipate them or not. I mean, the idea, on one side you have people who say that you can't anticipate them, because if you could anticipate them, there wouldn't be a bubble in the first place. On the other side, there are people that point to things like what happened in the housing market, and you looked at the value of the house relative to rents, and it's pretty obvious that the housing prices were getting really high relative to rents, and that was probably unsustainable. I think the debate about whether you can recognize bubbles or not is really not the part of the debate that's that sort of rewarding or germane. What I think is more important to focus on is maybe you're not certain it's a bubble or not, but are there tools that the Federal Reserve can put in place that supplement monetary policy, that allow the Federal Reserve to, or some other regulatory agency, to regulate the amount of leverage in the system? Because one thing that we saw during this crisis was there was a huge increase in leverage among the securities firms, and that leverage definitely contributed to credit availability and the compression of credit spreads, and that definitely contributed to what happened to some of those firms in the crisis. So if the Federal Reserve, one thing that I'd like to do is see the Federal Reserve work on seeing what kind of tools can be put in place to develop another instrument that can maybe limit that degree of leverage. If we can prevent the buildup from leverage, we can probably reduce the amount of risk in the system. So that's, I think, an avenue for future work.
Unfortunately, I think we're going to have to close this session since we want to get everyone out at 9:30. I want to thank Bill, and I want to thank all the panelists. But what I would also say, and this is my personal view, that I think it's absolutely essential, and that was the theme in this panel, that people in this room who can influence in major ways speak out, and speak out strongly about the independence of the Fed and the important role that it plays in our economy. We just can't sit back and expect the Fed to be able to do it on its own. And I am absolutely convinced, as I think we all are, there is no way we would have gotten through this financial crisis without an independent Fed, and we need to make it clear to both political parties, we need to make it clear to the White House, and we need to make it clear to the public of the importance of an independent Fed. Thank you very much.